In recent days, there has been much discussion of the possibility that the RBA might raise interest rates in coming months. This expectation began with the higher than expected monthly CPI rate of a trimmed mean of 4.4% for the month of May 24. This was smartly up from the trimmed mean of 4.1% for April. A further change of sentiment towards a rate hike was the release of the RBA minutes for the 17th and the 18th of June. These minutes showed that the RBA had considered the possibility of a rate hike at the meeting and holding rates steady at the meeting, but there was no consideration of a rate cut. And that suggested to the market that the RBA had a decided tightening bias. We don't think that the RBA is going to tighten in coming months, and there are two reasons for that. The first is that our model of the cash rate doesn't suggest it. Our model is based on data for the cash rate since 1990, which was when the cash rate was actually invented in Australia. And our model explains 89% of monthly variation in the cash rate since that time. Our model considers the impact of core inflation on the cash rate. It also considers, and importantly, the impact of unemployment. It further considers inflationary expectations, where the market thinks that inflation is going to go. The model suggests that whereas monthly inflation explains why cash rates are where the cash rate is now, unemployment is much better at explaining where the cash rate and inflation will be in future months. Our model gives us an equilibrium estimate. And this morning when I ran it, the model estimate was 4.4%, which is only 5 basis points higher than the current level. And that's just not statistically significant. The increase in inflation is not yet sufficient to generate the need for a rise in rates. This brings us to unemployment. Our model tells us that future inflation is increasingly sensitive to unemployment at lower levels as unemployment falls to lower levels. That means when you've got unemployment, when you've got the jobs market really tight, or as it has been, and the tightest for some 50 years, then inflation is much more responsive to change in unemployment than it is when unemployment is much higher. So our model tells us that there's very little difference on fundamentals right now. So in short, we think that rather than rates go up over the next year, it is far more likely that unemployment is going to go up. This rise in unemployment will put downward pressure on future inflation and forestall the need for future rate hikes. The reason for this rise in unemployment comes from the steady fall in employment demand shown in the fall of job ads. Now, when I put this piece out, I'll show a chart of the peaking in job ads and how they've fallen from that peak. After finding a low of 43 which is an index level of 43 in the ANZ index, back in May 2020, the ANZ index of monthly job ads rose steadily month by month to a peak in November 2022 of 167. And it was a seasonally adjusted level of 158. From that peak at the end of 2022, we've had a steady decline. And by June 24, which is the most recent numbers, the level had fallen on an original basis to 118. So we've had this major fall in job ads. And what we've done is we've done a little model of how those movements in job ads generate future movements in unemployment. And we found that that decline in job ads leads an increase of unemployment by a lead of about 6 months. Put simply, as job ads continue to fall, then 6 months later, unemployment will continue to rise. Our model of this relationship suggests that beginning with the data at 2020, falls in job ads explain around about 80% of rises of unemployment with a lead of about 6 months. So the ABS tells us that Australian unemployment stood at 4% in May 2024. That's the most recent number. Our model of falling job ads suggests that this number is going to increase significantly to 4.8% by the end of the year. So what you're going to get, given that we've had a sharp fall in job ads, you're going to have a significant increase in unemployment in the second half of the year. The problem is that Australian job ads are likely to continue to fall, and this will generate a likely level of unemployment of 5% by the time we get to around about the middle of next year. So in short, we don't think that the RBA is going to increase interest rates from here. Unfortunately, we think that the reason is that unemployment is going to start to rise, and from here, over the next year, it's going to be much, much higher.